Welcome to today's deep dive. Our mission today is to unpack a sudden and just genuinely shocking financial anomaly in the usually very predictable world of dividend investing.
Yeah, predictable is usually the whole point.
Right, exactly. But we are working from this stack of source material analyzing Vanguard's high dividend yield ETF, which is ticker symbol VYM for those following along, and its unprecedented Q2 2026 dividend announcement.
Which really caught a lot of people off guard.
Oh, completely. We are going to break down exactly how a massive 500 stock conservative fund just delivered this double-digit growth shocker, the underlying mechanics of market cap weighting that actually made it possible, and what this signals for your income portfolios in what has frankly been a pretty punishing macroeconomic year.
It really has been a tough year. And, the world of high-yield ETFs, it's built entirely around the concept of predictability.
Right. Nobody likes surprises there.
Exactly. Investors flock to these funds specifically to avoid surprises. They just want a steady, reliable cash flow that ideally outpaces inflation. So exploring a statistical outlier of this magnitude, it requires us to really look past the headline numbers and dissect the structural plumbing of the fund itself.
Yeah.
Because this isn't just a blip. This is a fundamental shift in the income generation of a highly diversified portfolio.
I mean, to set the stakes here, I like to think of it like this. You know when you put on an old winter coat and you find a $20 bill in the pocket?
Oh, best feeling ever.
Right. But in this case, for investors holding, say, a $300 to $1,000 position in this fund, it's like reaching into your pocket and finding hundreds of dollars of newly minted recurring cash that just literally didn't exist yesterday.
That is a great way to put it. But to understand the sheer scale of the surprise here, we first have to establish what normal actually looks like for VYM.
Right. So we can appreciate the crazy outlier.
Exactly. Because this fund is meant to be a cornerstone asset for you, it holds over 500 different dividend-paying stocks, and it's designed to target a relatively safe 2.5 to 3.5% yield.
And historically, it delivers a dividend growth rate of, what, like 5.5 to 7.5% annually?
Yeah, right in that pocket. The entire value proposition is just massive inertia. You sacrifice explosive growth for the absolute guarantee that the income stream won't suddenly dry up.
It's the tortoise in the race.
Right. And that inertia is incredibly visible in the payout history. Let's just look at the baseline. So in the first quarter of 2026, this past March, VYM paid out 86.17 cents per share.
Okay, so 0.861 seen.
Yes. Now, if we look back at the second quarter of the previous year, Q2 2025, the fund paid out 86.17 cents per share.
Down to the fourth decimal place.
Literally mathematically identical.
Which is statistically staggering when you actually think about the underlying mechanics of it.
Oh, it's wild.
Because, the fund manager is pooling individual dividend checks from over 500 different corporations.
Yeah.
Right. All operating in different sectors. They all have moving financial targets.
Yeah.
For all of those underlying corporate board decisions to just net out to the exact hundredth of a penny twice in a 12-month span, it just highlights an incredibly rigid internal equilibrium.
It really demonstrates the smoothing effect of holding 500 stocks. The few companies that, raise their dividends are just perfectly offset by the companies that cut or pause theirs.
Right. Now, there is one historical exception to that 86-cent baseline, which happens in December.
Ah, yes. The December exception. Year-end payouts for ETFs are just fundamentally different structurally.
Because the fund is dealing with realized capital gains then, rather than just passing through those corporate dividend checks.
That is the core distinction, yeah. By law, an ETF is structured as a pass-through entity. So if the fund managers sell off certain stocks throughout the year to rebalance the portfolio, maybe because a stock no longer meets the high yield criteria, or there was a corporate merger, they generate net realized capital gains.
And the IRS wants its cut.
Always. The IRS requires the fund to distribute those gains to shareholders, at least annually, to avoid the fund itself being taxed. So Vanguard, like most managers, clears this bookkeeping requirement by just rolling those capital gains into the big December distribution.
Which artificially inflates that specific quarter. So like in December 2024, VYM paid out roughly 96 cents. In December 2025, it was about 94 cents.
Exactly.
So we have a very clear operational ceiling here. The mid-90-cent range is really only achievable when you inject a full year's worth of capital gains into the quarterly dividend pool.
That is the established ceiling. Any regular quarterly distribution, so March, June, or September, relies entirely on organic dividend generation from the underlying companies. Without capital gains, preaching 90 cents would require this massive aggregate shift in corporate payout policies across the entire U.S. economy.
Which brings us to the Q2 2026 anomaly.
Right.
The regular June dividend just dropped, and Vanguard announced a payout of 97.95 cents per share.
Which is just, it's unheard of for June.
Right. It bypassed the high 80s, totally bypassed the low 90s, and just shattered the historic December capital gains ceiling during a regular quarter. We're looking at a 13.67% year-over-year jump.
It is the highest non-year-end payout VYM has ever delivered, period.
Okay, let's unpack this. Let's really look at the math on this, because a 13% jump in a 500 stock index, it completely defies the very concept of index inertia we just talked about.
Oh, absolutely.
If you have 500 companies and the aggregate average of their payouts jumps by nearly 14%, it implies a massive synchronized wave of corporate generosity. But we know that isn't happening in the broader economy right now.
No, not at all.
So this means the 500 stock average didn't move organically. It's like trying to turn a massive cargo ship into a speedboat. A single, top-heavy outlier is skewing the entire pool.
You are identifying the exact flaw in assuming a 500 stock ETF distributes influence equally. VYM is a market capitalization weighted fund.
Right.
And the massive outlier skewing the specific pool is Broadcom.
The chip maker.
Yes. Currently, Broadcom constitutes over 8.5% of the entire fund's weight. And in a diversified ETF, an 8.5% concentration in a single company, that is an immense centralization of power.
So let's drill down into how market cap weighting actually functions here, because it really explains the mechanics of the shock.
Yeah, it's crucial.
Because an ETF like VYM doesn't just buy an equal number of shares in all 500 companies, right?
No, not at all.
It tracks an index, and its internal rules dictate that the larger a company's total market value becomes, the larger the percentage of the ETF's capital must be allocated to that specific company.
Right, and that mechanism creates a compounding feedback loop during a bull market. As Broadcom's stock price skyrockets, its market capitalization expands.
Yeah.
Consequently, when VYM rebalances, its mandate forces it to hold a larger and larger proportional dollar amount of Broadcom compared to, say, a stagnant company.
So if Broadcom goes from being, 2% of the U.S. market to 8.5%, VYM's internal holdings must mirror that ratio.
Exactly.
Meaning that when dividend season rolls around, 8.5% of the total cash flowing into Vanguard's collection bucket is originating from the accounts payable department of just a single company.
And it entirely changes the risk profile of the income stream. I mean, what's fascinating here is that Broadcom is a titan in the semiconductor space, right?
Yeah.
And they are capturing an immense amount of capital from the ongoing artificial intelligence boom and the global build-out of networking infrastructure.
They're selling the picks and shovels for the AI gold rush.
Precisely. But unlike many pure-play tech growth stocks that reinvest every single penny back into research and development, Broadcom has this very unique dual-engine business model.
They actually generate liquid cash flow that they're willing to part with.
They do. They possess highly mature, incredibly high-margin legacy networking and software divisions, particularly following their big acquisition of VMware.
Right.
So those mature divisions operate as cash cows. Broadcom can fund its aggressive AI expansion while simultaneously funding aggressive dividend increases.
Wow.
And as they hike their dividend per share, and as VYM is forced to hold more of those shares due to market cap weighting, Broadcom's cash flow effectively hijacks the ETF's baseline yield.
The source analysis refers to this as the division of Broadcom effect.
Which I love.
It's a great term for it. Because it's like the ETFs is behaving less like an agricultural co-op where 500 farms contribute to the harvest equally, and more like a co-op where one single farm discovered a hyper-cash crop, bought up the adjoining land, and now just dictates the revenue of the entire organization. Where Broadcom goes, VYM's distribution follows.
The structural irony here is just profound. Investors historically allocate capital to VYM specifically to insulate themselves from the volatility of the tech sector.
Right. They want safe and boring.
They want a boring, value-oriented income strategy, yet the mechanics of market cap weighting have temporarily tethered this conservative income vehicle directly to an AI semiconductor boom.
It's like hiring a massive choir of 500 singers for a gentle harmony, but one guy in the front row has a megaphone, and is suddenly belting out heavy metal and the audience loves it.
That is exactly what it's like.
Which requires us to look at why this specific spike is generating such a massive sigh of relief from investors right now. Because we understand how Broadcom's massive cash generation intersecting with Vanguard's weighting rules, but the real-world impact really requires context here.
It does.
2026 has been a remarkably punishing environment for dividend investors.
The macroeconomic landscape this year is defined by capital preservation. Inflation has remained stubbornly sticky and borrowing costs are elevated.
Yeah, money's expensive.
Right. And when debt is expensive, corporate boards hoard cash. They are not authorizing massive dividend hikes. We are seeing major established companies offering token 1 or 2% dividend increases simply to maintain their status as quote-unquote dividend growers.
And a 1% dividend increase in a 3 or 4% inflationary environment is a functional pay cut.
Exactly.
If a retiree relies on that yield to cover their grocery bill, and the yield grows slower than the cost of the groceries, their portfolio is literally bleeding purchasing power. They are moving backward while still taking on equity risk.
That is the core frustration in the market right now. The reliable stalwarts are just tightening their belts. Dividend growth across the S&P 500 has been largely anemic.
Yeah.
And VYM itself has suffered from this lag over the last few years. Investors were collecting the base yield, but the annualized growth rate was falling short of that historical 5.5 to 7.5% target.
So let's look at the cumulative math to show exactly how Broadcom's intervention shifted the reality for an investor holding this fund.
Let's do it.
In the first half of 2025, if you combine the March and June payouts, VYM distributed about $1.71 per share.
Right.
Through the first half of 2026, combining the stagnant March payout with this massive new June anomaly, the fund has distributed roughly $1.84 per share.
And that equates to a 7.57% year-to-date dividend growth rate.
It pulls the entire fund's trajectory violently back into its promised historical target range in just a single quarter. For an investor, utilizing a substantial position in this ETF as an income engine, say a $300,000 portfolio, this isn't just a spreadsheet victory. This is a really meaningful shift in the compounding curve.
Oh, absolutely.
It translates to hundreds of dollars of newly realized liquid cash that can either, offset the sticky inflation of 2026 or be automatically reinvested at higher yields to accelerate the compounding snowball.
It is the realization of the strategy working in real time. This is why you do it. The underlying mechanism of an index fund is designed to capture the winners of the broader economy automatically.
Right.
Broadcom is the current winner, and the passive investor reaps the reward of that corporate success without having to actively identify or trade the individual stock.
But here's where it gets really interesting, right? Are we celebrating too early? I want to pivot to the mechanics of the payout itself, because while a 14% quarterly jump is a massive win, treating it as a permanent new baseline kind of ignores how ETFs actually process capital.
It does.
Vanguard didn't suddenly invent new cash, they just emptied the collection bucket early. We need to look at the timing quirk, risk identified in the source material. Is this a permanent win, or did Vanguard just empty the piggy bank early this year?
This raises an important question, and applying skepticism here is really essential. A
Yeah.
single outlier quarter does not equal a permanent trend, largely because of the discrepancy between corporate payment schedules and ETF distribution dates. Let's break down the 90-day collection cycle.
Okay, so when an investor holds VYM, they aren't receiving individual checks. Vanguard acts as the intermediary.
Right.
Every quarter, Vanguard establishes an ex-dividend date, basically a cutoff line. Any corporate dividend paid into the fund's accounts before that cutoff goes into the Q2 bucket.
And the vulnerability there lies in the calendar. The timing of VYM's unified distribution is entirely reliant on the boardrooms of the 500 underlying companies.
Okay.
So if a cluster of heavily weighted companies traditionally pays their dividend in the first week of July, those funds belong in the Q3 collection bucket.
Right. That makes sense.
But if those corporate boards decide to accelerate their payout schedules, perhaps moving the payment date to the last week of June for internal accounting purposes, that cash suddenly crosses the Vanguard cutoff line.
Oh, it falls into the Q2 bucket instead.
Exactly.
So the ETF's overall annualized income didn't necessarily grow. The cash merely shifted across an arbitrary quarterly boundary.
This phenomenon creates a critical blind spot in quarter-over-quarter analysis. If June's 13.67% spike was heavily influenced by accelerated corporate payouts, It means Vanguard effectively just borrowed capital from the future.
Setting up a massive cliffhanger for the Q3 distribution in September.
Yes.
If we reach September and the payout collapses back down into the mid-80-cent range, it confirms that the June anomaly was just a calendar quirk.
Yep.
The fundamental growth rate of the portfolio didn't shift, just the timing of the cash flow did.
Conversely, if the Q3 distribution maintains a high baseline or demonstrates, moderate year-over-year growth, it provides empirical evidence that the underlying dividend engine of the index has genuinely accelerated.
Which would be huge.
It would be. And this highlights why analyzing income ETFs requires a trailing 12-month methodology. You must look at a full rolling calendar year to smooth out the pooling distortions, ex-dividend misalignments, and capital gains distributions. Focusing on a single quarter just invites a false sense of security.
We're also looking for corroborating evidence from the broader market, right? The source material points out that the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD, is preparing to announce its Q2 distribution.
Yes, SCHD is a great benchmark here.
It's a major peer in the high-yield space, but it utilizes a totally different underlying index and a different weighting methodology.
Comparing the two will be highly instructive. If SCHD also reports a massive, unexpected payout spike, it suggests a broader, unannounced shift in corporate dividend policy across the macroeconomy.
Like maybe things are getting better everywhere.
Exactly. However, if SCHD falls victim to the stagnant 1 or 2% growth trend characteristic of 2026, it isolates VYM's performance.
Oh, I see.
It would confirm that VYM's spike is almost entirely a localized phenomenon, driven by its specific exposure to the Broadcom and AI megatrend.
It isolates the variable. So what does this all mean? To pull all of these threads together, we began with a highly conservative, famously rigid ETF that typically trades explosive growth for predictable stability.
Right.
And that stability was completely fractured in Q2 2026 by an unprecedented 13.67% payout spike.
A spike engineered by the mechanics of market cap weighting, which allowed a single semiconductor titan, Broadcom, to leverage its massive AI-driven cash flow to dominate the income profile of a 500-stock index.
This structural quirk provided a vital injection of real purchasing power to income investors navigating a year defined by tight corporate belts and sticky inflation.
Yeah, it really did.
It pulled the fund's year-to-date growth rate back to 7.57%, rescuing the compounding curve for long-term holders. But it also requires us to watch the upcoming Q3 data meticulously to ensure this wasn't just a calendar alignment pulling cash forward from the fall.
And all of which leads to a critical reevaluation of portfolio theory for the passive investor.
Yeah.
The underlying premise of purchasing a 500-stock dividend ETF is risk mitigation through extreme diversification.
Right, you buy 500 stocks so you don't have to worry about one failing.
But if the fundamental mechanics of market cap weighting allow a single mega cap tech stock to essentially rescue the growth rate of the entire fund, it exposes a hidden layer of concentration risk.
Because the index rules literally force you to buy more of what is currently expensive.
Exactly the issue. The upside of that concentration is thrilling when the sector is booming. But investors must ask themselves, if their supposedly safe income portfolio is currently tethered to a semiconductor company riding an AI infrastructure wave, what happens to their supposedly stable dividend growth if the AI boom cools down?
Oh, wow.
If capital expenditures in the tech sector contract next year, are conservative dividend investors going to absorb the collateral damage of a tech correction?
It forces you to question the true nature of your diversification. Are you holding a broad representation of the U.S. economy, or are you just holding an AI infrastructure fund with 499 silent partners?
That is the big question.
We will certainly be watching the upcoming SCHD data and the Q3 trailing 12-month numbers closely to see how this all plays out. Thank you for joining us for this deep dive.